Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com comments on the sticky situation crude is in. Wolf Richter, publisher of wolfstreet.com, talks about the bumpy stock market, housing, and interest rates. International tax expert Peter Ingram has some cross-border tax advice. What works in Canada might get you into a lot of trouble in the U.S. and vice versa. Plus, at the end of the show, we'll have company showcase updates from American Manganese CEO Larry Reaugh and Aven Resources President Jim Pettit. We'll talk to Ross Clark right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com. Welcome back to the show.
Always a pleasure, Jim.
Crude oil taking it on the chin.
Yes, Friday was a pretty disastrous day. I mean, we've been trending down at a fairly consistent pace, but really gained some momentum there on Friday, down just shy of $50, and lowest level in over a year. Not out of the line of what we've been hoping for, that we would get a 35% drop off the highs of the last couple of months. That actually was a target of $49.90, so we are inside $1 in terms of the target at this point. Lots of good oversold readings, and as we have been thinking, at some point here we would get a bounce. However, whatever low we're putting in at this point, I think needs to get retested. So you get a bounce. It could be a week or two, but that will probably get a little overbought, and we'll get one of our bearish springboard readings, I would suspect, on that bounce, and then back down to test the lows. And if that happens, we could be set up for some really good turn of the year opportunities where the tax selling pressure in the stocks really could come to a head, and could get a pretty bounce out of December into January. This oil price, as we mentioned to subscribers earlier this summer, with a hard break like this, it's having an impact over into the high yield area. The HYG and JNK ETFs are getting hit, not quite as hard as the oil market, but pretty badly. Also getting extremely oversold. So yeah, they could be looking for a reasonable bounce as well.
If oil goes down, does it take the Canuck buck with it?
Normally you'd see this really close relationship, and we would be looking for potential divergences. The fact is that the Canadian dollar has been holding up exceptionally well. It's given up, what have we given up? About 3 cents now since September, which on a relative basis is nothing compared to what we've seen in terms of the drop in the oil price. So I think the Bank of Canada seems to be looking at some better potential numbers for GDP growth next year, more than I think the market is looking for. But they're talking up the economy rather than talking it down. What I would be looking for, and it's interesting here. This week, the dollar did manage to put in a higher low midweek than it had the previous week. So there's a bit of a bullish divergence setting up here that might give a bit of a lift to the dollar, especially if oil decides to have a bounce. So it wouldn't be at all surprised that the near-term pressure on Canadian dollar that we've seen since early October might have a bit of a reprieve here.
Is there any safe haven right now, or is the whole market in danger?
Well, normally you'd expect to see a bounce in the precious metals, and we did have one a week and a half ago, had a good bounce off the low, but we got gold here stuck in this mid-1220s, sort of 1225, 1230 has been the overhead resistance. I still think that this is in need of trying to break out through the 1235 area to show that there's any kind of a longer-term bottom in place. Right now, we're still looking at this as a downtrend with just a recovery rally in it. See the same thing over in the silver market. Just haven't seen any flight to safety there. The bond market, interestingly, with the equity market starting to soften up, we're seeing the bond market firming. And so we're starting to see slightly lower rates as far as the 10 and 30-year rates are concerned. That was something we talked about a few months ago, that or a couple of weeks ago, if rates didn't continue higher, if they actually started to roll over, that would be indicative of a slowing economy, potentially, and have some pressure over in the equity market. Now, in terms of the equities, we've really been led down by the FANGs, which had been so good on the way on the upside. Apple's given back over 40% now if it's rally from the 2016 low, and if it was to give back 50%, which is around 161 or 162, I think that would be a great opportunity for short-term traders to take advantage of.
Ross, thank you so much for being on the show.
Good to be with you, Jim.
Coming up, Wolf Richter, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN.AF. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Wolf, Americans are in love with their credit cards. Are they running into trouble? And is subprime starting to be a big issue?
Yeah, credit cards in the United States are something that consumers have learned the hard way to deal with, and in Canada, you never really had a full-blown financial crisis when we did, and so during the financial crisis in 2008, 9, and 10, consumers shed about 20% of their credit card balances, so that deleveraged. They went from $1 trillion in credit card debt down to about $800 billion. And then they gradually built back up their balances, charging more to it, et cetera, et cetera. And the shedding, the 20%, shedding of credit card balances, some of that was done because consumers tried to pay them off and so forth. And another part was done because consumers defaulted on their credit cards, and banks took some significant losses on those defaults. So banks too learned the lesson, the major banks became much more prudent in the underwriting standards, which is what we're going to get to here in a moment. So since then, consumers have built up the credit card balances, and so now we're back where we were in 2008 at around $1 trillion. And at the same time, the population of the United States has grown by about 20 million people, and there's been, 10 years of inflation and nominal wage increases. So on a per capita basis, the burden of that credit card debt is now a lot less than what it was 10 years ago. At the same time, we see a real split now, and that is very concerning. The big banks, so the largest 100 banks, and the Federal Reserve reports that separately. So we have data on the largest 100 banks in the United States, and then on the 5,000 or so remaining banks. And, the United States is full of little local banks, and then we have, a dozen mega banks, and then there's the regional banks in between, the fairly large. And so the largest 100 banks of that 5,000 total banks, they have really cleaned up their credit card lending, and they have come out with very aggressive, very good marketing strategies such as cash rebates and miles. Some of those cash rebates go up to 6% on groceries and whatnot, And so they offer these incredibly good incentives to people to get their credit cards, and then they get an avalanche of applications and they cherry pick them. So they pick out the customers with the best credit profiles, and they sign them up, and they reject the customers that have weaker credit profiles and lower credit ratings. And these rejected customers then end up with smaller banks that cannot offer those kinds of incentives, and they take customers that might not be able to get a credit card from a major bank, and they're charging 25 or 30% interest on them. The credit card business is immensely profitable. The cost of funding for banks in the U.S. is still below 1%. And so when you get 15 or 20 or 30% interest on a credit card, almost all of it is pure profit. And if you can collect some of that for a while, and then the customer defaults on you, then you've been paid for it, and it's usually not a huge issue. But so what we're now seeing is that at the big banks that have picked the best customers and that hold the majority of the credit card balances, the credit cards are holding up pretty well. So default rates are ticking up a little bit, but overall they're holding up really well. But at the 4,900 or so smaller banks, the default rates have spiked. And they have now reached a level of 6.2% of outstanding balances, or those are delinquency rates, so 30 days or more delinquent. And at the smaller banks, those balances are now 6.2% of the overall balances that they have. And that 6.2% delinquency rate is the highest in the data series. It's higher than it was during the financial crisis. And that spike started in 2017, up from 3%, so it doubled over the course of about 3 quarters or 4 quarters, and is now reached this level, and it doesn't appear to be leveling off either. So this shows us that these most vulnerable customers that have been attracted with the offers that the smaller banks have, and they've been rejected elsewhere, and they may not have a lot of choices, that they're now starting to get in serious trouble. So the overall credit card delinquency rates are really strong, and so everybody says it's no big deal. Our credit card delinquency rates are small, but when you look at the individual consumer groups at the most vulnerable levels, we're starting to see some real weakness. And this is happening even while the economy is very strong and unemployment is very low, and and employers having a hard time filling the job offers they have, and so the economy is good. And this is not happening because of the economy. This is happening at this point because these vulnerable consumers have an issue of some sort, and they overcharge from the credit cards. They can't fund out of the income. They can't fund the 30% interest that they have to pay on the credit card balance, and and they become delinquent on them. And this is concerning because eventually we're going to get a recession. There's no way to avoid a recession. The business cycle has not been canceled. And there's nothing unusual about recessions. They always happen eventually. And it's sort of a cleansing process that businesses have to go through. It's when the credit cycle turns the other way and a lot of debts get renegotiated or written off in bankruptcy court or elsewhere. And the unemployment goes up and so forth. And this is going to come at us here in the near future. Now, maybe not next year, but probably no later than 2020. And and that's when credit card delinquencies usually spike, is during the recession when things get rough for consumers. But for the most vulnerable consumers right now, they're already spiking. They're spiking at the peak of the economy. And so this tells a little bit what we're going to look at when the economy actually slows down, that at the most vulnerable level, consumers have a lot of debt. They don't have a lot of income. We've seen that time after time, that the income at the lower level, so we're talking about the lower 40% income spectrum, that incomes have not risen. The incomes have risen at the upper end of the spectrum, but not at the lower end. So these are consumers that are struggling. That get kind of lost in the overall averages, but they're struggling and they have charged up their credit cards and now they're getting in trouble. So I think the American consumer at that level will experience some real pain. And, especially the smaller banks, will grapple with that. Obviously, greed on the bank side governs us a lot. If you charge somebody 30% interest on a credit card, you're almost guaranteeing that customer will default. Because there's no, if you don't have enough money to buy the couch with cash you have in the bank, you have to charge it on your credit card. How are you going to pay 30% interest on it? And that's the thing about it. It's for the banks, a 30% interest rate is a short-term income booster, but it's they're setting themselves up for writing off some of these balances. So there are going to be some losses. Now, the amounts are not huge overall in terms of billions of dollars, but since smaller banks are much more fragile than some of the bigger banks, we'll probably see some difficulties among them. But the real real data point here that we need to focus on is the American consumers at the lower end of the income spectrum and how burdened they are by these debts. And, at the same time, how they're being lost in the averages of the overall numbers. And there's a lot of very well-to-do Americans out there, who borrow money on their credit cards because they've got big house payments, all kind of other things, and they probably won't get in trouble. And they probably don't have 30% interest on their credit cards either. They're getting 8.5%, 9% maybe, or maybe even better if they have a good credit background. So these are not consumers, these well-to-do consumers we're not going to worry about them. We're going to need to worry about the 20% and the 40%, that are struggling at the bottom of the income spectrum, and that we're already seeing weakening right now to a very significant extent, and that's very worrisome.
Do you foresee the big banks getting into the same trouble they did last time when the government had to bail them out? Only this time they have legislation that will dip into your bank account to bail out your big bank. So do you see this happening?
No, I don't see that. There's a lot of things being said about the legislation to allow banks to dip into customer accounts. Now, our accounts are insured by the FDIC, our Deposit Insurance Corporation, a federally funded one, and banks fund that actually. The FDIC, I personally have been involved in 3 bank collapses with my accounts. I have never lost a dime. All my accounts are insured by the FDIC. The insurance limit is $250,000 per. You have to read the limits, but you can own CDs in different banks, and each one is insured up to $250,000. So, you can have a lot of money in the bank and it's federally insured. So this is not a problem. I don't see any kind of issues with with savers out there or bank accounts being confiscated or any of these things. I also know that the big banks are much better capitalized than they were before the financial crisis. And before the financial crisis, that part was really a mess, and it was obvious. Now they have been recapitalized on the backs of savers after 10 years of not paying any interest to their savers. They have had huge profits. They had to retain those profits. That couldn't for many years. They weren't allowed to pay dividends or to share buybacks. So they piled up large amounts of capital, and they can take pretty significant losses, which they couldn't before. So the credit cards are not going to jeopardize the big banks. They have so much capital they can easily eat significant losses. The auto loans are, they're not really jeopardizing banks either. And yes, a lot of this debt has been securitized into asset-backed securities, so now investors own those and not the banks. So the risks are spread around. They're sitting in pension funds in Norway and elsewhere. So, I don't envision the banks get in trouble over consumer debt. The big banks may get in trouble over other things like commercial real estate and, possibly housing, but particularly commercial real estate, and then all the high risk trading that they're doing in the derivatives market. So, there are other risks out there for banks, but in terms of consumer debt, I don't see that to be a significant risk factor this time around.
We'll have more with Wolf Richter when This Week in Money returns.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter. Wolf, why are we seeing all these fireworks in the stock markets right now?
Well, we've had an incredible run-up that started in 2009, and it was petering out in 2016. The S&P 500 was already down almost 20% in early 2016. And then it recovered, but just kind of flat in most of 2016. And it was going through this topping process that we typically see. And after these huge run-ups, we're really setting up for a nice long correction. And then Trump was elected, and we got the Trump bump. And the Trump bump is visible throughout the entire U.S. economy. It's visible in the most liberal parts of the country on the West Coast. It's visible in San Francisco where Trump got about 9% of the popular vote. It's visible in home prices, in commercial real estate prices, in stock prices. Everything boomed. We had a strong pickup in consumer spending, even by people who probably hate Trump. It was just a massive change in how the economy responds. There were tax cuts. There were all kinds of other short-term incentives being thrown at the economy, and this has caused a surge in economic growth in the goods space sector as well as in the service sector, and it has really inflated asset prices by quite a bit. And since the election of November 2016, the Dow went up over 40%, the S&P 500 over 30% between then and the peak in August. And this is a couple of years, less than 2 years. Now, these are huge numbers. And that Trump bump is now petering out, and people realize, oh my God, we are up this high. We have made it up all the way to here. Now we're looking down, and we're getting dizzy, you know. It's a long ways down, yeah. And so we just went through one of the worst Octobers anybody can remember. And so today the data came out about margin debt, and this is tracked by FINRA, our broker regulator, and margin debt plunged by $40.5 billion in October. That was the steepest plunge since the Lehman moment, since November 2008. And margin debt is, there's a lot of leverage in the stock market, but this is just one slice of the leverage, and it's still over $600 billion. But it's just only a slice of the leverage. But that's a slice that is reported that we know. We know what the other principles are, what they're at work, but we don't know the amounts. This one we know the amounts, and it plunged $40 billion because margin calls were going out and brokers were forcing investors to liquidate some of their stocks in order to pay down their margin debt, and it triggered more sell-offs and more margin calls. And this is exactly what happens at the beginning of a long-term sell-off. That the margin debt that has ballooned over the years and has cost part of the increase in the stock prices is now reversing, and it's going to cost part of the decrease in stock prices. Now, margin debt creates liquidity out of nothing. You know, I can borrow money, and then that money is lent to me by the broker, and then I can buy stocks with that money. So this creates buying pressure. And then when I have to sell these stocks to pay down the debt, you know, this happens when after stock prices fall. So I'm not going to get very much money for my stock anymore. I have to sell it into a plunging market, and I have to sell more possibly than I would otherwise because the stock price has dropped so much. And then when I pay down the margin loan with the proceeds from that sale, that money just disappears. It doesn't fit. It's not in my account. It's not cash on the sideline. It's not going into other assets. It just disappears. It just pays down debt. And, that just like this liquidity came out of nowhere to create this buying pressure on the way up. It disappears into nowhere on the way down. And so margin debt is the big accelerator on the way up, and it's the big accelerator on the way down. And when I saw this number that margin debt plunged by over $40 billion dollars today, yeah, that's a shocking number. And that tells me that people got margin calls, that hedge funds got margin calls, that individual investors got margin calls, that there was some forced selling going on in October. And this is just for October now. We don't have the November numbers yet. And November is starting to be pretty ugly too. But in October, you know, people got worried and people were forced to sell stocks, and to an extent that we haven't seen since the financial crisis. So I think this marks the end of the Trump bump for sure, and probably the beginning of a fairly long and significant sell-off.
Are they going to nickname this the Trump dump if they had the Trump bump?
Well, the thing about a bump is that it goes up on one side and goes down on the other side, and people forget that. You know, they think a bump is it goes up and then it plateaus and doesn't go down. And that's not a bump, you know. A bump goes up and then it goes down, so I'm when you look at something like that, I think if you call it a Trump bump, that will be a pretty good description. If it goes down a lot further than where it started, and there's a good chance it will do that, then maybe people might call it the Trump dump. But I don't think it will happen that quickly. You know, there's a lot of cash waiting to jump in at every sell-off. You know, the dip buyers are very strong, and some of this is driven by algorithms and hedge funds. And hedge funds have collected in their funds billions of dollars just waiting to jump in. So I don't think we're going to see any kind of crash here. I think it's just a long, drawn-out downtrend that's going to unwind what we call the everything bubble, these inflated asset prices that we have seen for years, and they're going to be unwound, but in a kind of a messy but gradual way over many years.
We'll have more with Wolf Richter when This Week in Money returns.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. Wolf, how is the housing market doing on the U.S. West Coast?
Probably not unlike the housing market in Vancouver. We've had, obviously, enormous home price increases here and in different markets. So the three major markets on the U.S. West Coast, from north to south, are the Seattle metro market, then the Bay Area, and then Southern California, so the Los Angeles area. And in all three markets, home prices have surged over the last few years. The most expensive of these markets is the Bay Area, particularly Silicon Valley and San Francisco. And the median house price in San Francisco is $1.6 million US, and the median condo price here is about $1.2 million. And these are not huge fancy places; these are just basic dwellings, and they are completely out of line with the median income in the city. And even though there's a lot of wealthy people, but the housing market can't be nurtured by the top 15% of income earners. The median home price needs to be affordable to the median income earner, and if it's not, if the top 10% are the only ones that can buy a median home means 50% more expensive and 50% are less expensive. So, if only the top 10% can afford a median home, then that's a real issue with demand eventually. And that's what we're running into now. And, so suddenly, and this started in July, just all of a sudden, and maybe that has to do with the unwinding of the Trump bump too, all kinds of inventory started showing up on the markets. So the supply surged, and that's in all three markets. And for example, in King County, which is where Seattle is, it reached the highest level since the housing bust in 2010 and 2011, in that range, and almost double from where it was a year ago. In Silicon Valley and San Francisco, there was a similar increase in the supply, just surging on the market. At the same time, sales are slowing down. So, the supply is up by a huge amount, and sales are drifting lower. And so you get buyers that are not really eager to buy. They're shopping around. There's no bidding wars anymore. You get some classic prudent behavior where people are actually checking things out before they're buying. And then you have sellers that suddenly, they do an open house and no one shows up. And, they expected bidding wars and no one shows up, so now they're having to cut the asking prices to get people to even show up. And so that's a number we're looking at, is the number of price cuts, of listed homes. And that number of price cuts has completely blown through the roof. And you're looking at tripling from one year to the next. So from October to October, you had price cuts that were in the maybe 1,000 properties at the price is cut. Now it's 3,000 properties at the price is cut. They still haven't sold. They have to cut the asking prices to even get people in. Then the process is that now sellers have to find where the buyers are. The buyers are the market. So the market has walked away from the sellers. And the sellers are still thinking in terms of aspirational prices. They still think I'm going to get X $1 million for my home, so they put it on the market at that, and no one shows up. So now they have to cut prices low enough to where people are starting to get interested, and they're showing up for their open houses, and they're starting to be interested in buying. And when sellers do that, they can make a deal. So there are sales that are happening, but they're not happening at their old prices anymore. And so these are the two numbers we're seeing right now that indicate that the turning point in the housing market was last July, and that the fundamentals in the market are just deteriorating. Now, housing markets don't move very rapidly. They take many, many years to play through their cycles. So we don't expect any kind of plunge or collapse or any kind of panic or anything. We're just watching now the fundamentals deteriorate. We're watching sellers becoming more realistic and cutting their prices, and we're watching buyers walking away from homes instead of buying them. And the average asking prices have already come down. They surged by the double digits in prior years, and so now they're starting to come down. The median prices are still up year over year, but on a month-to-month basis, they have started to drift down. In terms of the Seattle Metro, for example, the Case-Shiller index that we have, which tracks sales pairs of homes, so it compares how the same home sold last time, and they have an algorithm that compares the prices. So it's based on sales pairs, and it shows a significant drop in the Seattle Metro in prices over the last 3 months, and that had spiked, and that spike is now being unwound. But we still haven't seen the year-over-year drop that you're already seeing in single-family houses in Vancouver in terms of prices, and we're lagging a little bit behind. We're probably half a year behind that. But the fundamentals of the West Coast markets have sort of turned together this summer, and in a very significant way. So we'll probably over the next, and the fundamentals meaning too that in the Bay Area there are just not enough people that can buy a median home. You just run out of buyers. If only 10% can buy a median home, you're going to run out of buyers sooner or later. And that's a real problem. That's less of a problem in Seattle because the market isn't quite that expensive. And it's less of a problem in Southern California because the market's also a little less expensive than in the Bay Area. But this is one of the problems in the Bay Area that we can't get around. And now we have Facebook and others getting in trouble in the stock prices. And in Silicon Valley and in San Francisco, our commercial real estate and residential real estate prices are running in parallel to the NASDAQ, and they have for decades. So the NASDAQ runs a little ahead, and the NASDAQ plunges enough, then our housing and commercial real estate prices go down. With like a 2-quarter lag or something like that. And this is just invariably happening. This always happens. So this is another pressure. Because so much wealth in the Bay Area comes from tech companies. And when that starts to evaporate like it has, and some of these tech companies are down 50%, and this is starting to hurt, and people getting tight in stock options and all these kind of things, and that's evaporating. So there'll be a lot of that kinds of pressures being exercised on the Bay Area market. The Seattle market has its own issues with Amazon. Amazon's down over 25%. So, that's a big player there. So I think the West Coast markets, you'll see them going into a fairly, slow but steady, downturn over quite a few years until the economics are balanced out again.
Has luxury real estate been hit by China's increasing crackdown on their currency leaving the country?
Yeah, and that's probably a factor in the West Coast, not just luxury real estate, but overall. I mean, they're buying at higher prices than median, so they're kind of at the higher end, but not all of it is luxury. But definitely, and luxury sales are kind of a weird thing anyway, because when you start selling something that's really luxury, so it goes for, $10 or $20 million, even in a good market, it may sit for a year before it sells, or even longer sometimes, something that costs $30 million, it's going to sit for a long time, even in a good market, because there's just not very many buyers for that kind of property. And they're marketed globally, and they don't really have a huge impact on the overall housing market. But the above the median, so if something is priced at the upper 80%, at the upper 20% of the market, so quite a bit above the median, in that range, there has been quite a bit of pain. And at the lower end, we see quite a bit of buying still, but at the upper end, and I'm not sure it's related to foreign buyers. It is to some extent probably. I mean, San Francisco, we have entire buildings that have towers, that have been marketed in China to Chinese investors. And, investors, not people who live there in these towers, but people who live in China and who invested in condos in these towers, and these condos are empty. So, some of that, demand probably evaporated as well. Canada is starting to make some efforts to document some of this, to get some numbers on this. We, in the United States, we don't have any kind of numbers on it. It's just anecdotal, and, so it's really hard to tell how much it is. I mean, the number I keep hearing is 5%, that about 5% of our purchases here in the Bay Area are foreign investors, non-resident foreign investors. But that's brokerages tell you that. Every major brokerage in the United States has marketing offices in China, and they market directly to Chinese investors. So this is a very common practice. All the major ones do that. And they're marketing as much now as they did before, even though it may be harder for Chinese investors to get their money out of China.
Wolf, if people want to know more about Wolf Street, how can they find out?
They can go to wolfstreet.com. Everything is free, and we post all kinds of great stuff every day with lots of charts.
Wolf, thank you so much for chatting with us.
Thank you, Tim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. Coming up, Peter Ingram, next on This Week in Money.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Peter Ingram. He's a cross-border tax expert with Senta in Vancouver. You can find him online at senta.com. Peter, welcome back to This Week in Money.
Thanks for having me.
Peter, just how important is it to get your tax planning done before year's end?
Well, it's a good question. Importance varies with each individual. But as it's always good to look at your situation before the year's end to see how things are going to line up. A quick talk with your investment advisor or tax consultant might lead you to some missed deductions or strategic capital loss planning.
How often do people miss, I would say, obvious deductions, but is it always obvious?
Well, not always obvious. I mean, we like to think that, everything is so easy to understand, but quite frankly, every year I get the same questions from everybody. What did I miss? And to think about what you miss, you really have to have an involved understanding of your personal situation, which is very complicated because your personal situation always changes. And then the tax laws change slightly as well. So we get stuck into using formatting and software with our active programs these days. But if there's ever a change or something that happens in your life that the difference is year to year, please ask your advisor, ask your investment portfolio manager if there is something that could have been brought into play now that your situation has changed, or if you've lost the benefit of something as well.
Are all tax software programs created equally or some better than others?
That is also a good question. The software provided differences between professional and personal type levels, but mainly just in terms of the broader application. I don't think that one is better than the rest. One certainly simplifies things when you're doing it yourself, but you still have to know what's needed to go where to use them most effectively. So some of the softwares ask really nice guiding questions along the way and just expect you to be able to answer, and your answers then get placed into where they would go on the tax return. And that's ideally taking away something, the job from somebody like myself who guides you through your personal situation as well. But if you use something without those guiding hints or help along the way, then ideally you're just flying blind into your tax return, unfortunately. So a good advisor, understands the tricks of the trade, but doesn't want to give you too much information because, the book's too big. What do you focus on? But takes the specifics of your life and then pulls what's important out of the situation to apply it to yourself.
Is it a false saving to try to do your own taxes once they start to get relatively complicated and not hire a professional?
I see very few personal tax returns that have been self-prepared, done to the 100% of their ability. My father would rant and rave. We gave 100 tax preparers the same tax return and got 99 different results. The laughing matter further is the IRS would accept all 99 of those different results because they're all prepared within reason. So it really provides a lot of open opportunity to be able to do something that the IRS or the CRA considers right, but it might not be best. Also, you can do something that's, negative in your situation. So to have a good advisor and a helper along the way is key.
The Auditor General just came out with a report saying that Revenue Canada did not apply audit rules fairly to everyone. Is that a common situation?
Well, the audit rules are standardized. What happens is you get a couple of agents that interpret the rules differently. Law is always interpretation, trying to fit within the lines to play legally. So you get people that interpret things differently. We get new generations of tax professionals. We get different things on the market. We get new investment types and whatnot. And we do our best in an evolving world to fit them into something that is unchanged and changes slowly. And then when you're dealing with cross-border, trying to figure out one country's laws into another country's laws when they just don't commute or compute, it becomes very difficult as well.
Would it help people, because Canada and the U.S. have such an intertwined economy, would it help if both governments kind of asked each other, what are you going to do with the same thing tax-wise, capital gains and so on, or because they're independent countries, you can't do that?
Well, you can't do that because they're independent. They fight for their differences. What we do have is tax treaties that prevents dual taxation. And to understand that, you figure out where the income is going to be taxable, claim it as taxable there, and then the country that you reside in will most likely offer a credit for the taxes paid to the foreign country. So there's a fairness provision out there protected by treaties and laws that then become even more difficult to attach to each individual's personal situation. So I specialize in reporting foreign income, preventing dual taxation, and making sure that nothing's missed to prevent unwanted failing to report penalties or unwanted fines coming out after the fact. As the government is never timely with their processing, they're quite often 2.5 years late in what we would consider assessing a tax return. So we might file a tax return this year, and 2.5 years from now, just within the statute of limitations, the government can come back and open it up for an audit.
Is it a good idea to hold on to your financial documents longer than the legal requirement?
Well, I like to say hold everything for 10 years. If you're dealing with an open asset like house ownership documents, you would never get rid of the purchase documents. And I deal with a lot of foreign property sales, and one of the biggest struggles that people have is they bought a primary residence years ago. They lost the purchase documents. They didn't keep track of all the capital improvements they did throughout the years. They changed this home into a rental property, and now there's a calculation for a primary residence exemption, and they've lost all the benefits or substantiating support for any of the adjustments to the cost base. And you're basically just losing out on a reduction of the entire capital gain and creates a higher tax paid. So open assets, things you still own, you should always keep the paperwork pertaining to those. A dead and done tax return could be discarded after 10 years. But people also, to go with purchase information for properties, same goes hand in hand for stock. If you hold a stock for over 10 years or your investment gets transferred to a different investment company and then to a different investment company, they quite often don't transfer the original cost base to your trade. So when you go to sell it, they can't substantiate the cost basis, and it's up to you to provide the accurate value. It becomes very difficult and cumbersome come tax time to track down those cost bases.
Can tax planning help ensure people receive cross-border taxation fairness?
Yes, absolutely. Fairness is one thing. I'm not going to say that taxes are unfair because there's always a cost to be attached for making income. It's unfair when you miss something and it goes too long to amend for. Now, something that's too long to amend for is going to be older than 10 years. Some benefits the government stop paying after a certain period of time, like a return of overpayments of CPP or EI. So there's lost benefits where you wouldn't want to make mistakes and let them go too long. But just one of those things. A good plan, being in touch with your personal situation, a financial plan is very important to not miss out and be caught in a situation that might feel unfair.
We'll have more with Peter Ingram when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Peter Ingram. He's a cross-border tax expert with Senta in Vancouver. Peter is part of the tax planning goal to get the taxpayer in the lowest income bracket that is legally possible to reduce taxes.
It's always the goal to pay less tax. But without a financial plan that properly accounts for your steady retirement income, we could reduce them too much. It makes little sense to contribute to an RRSP when you're in the lowest tax bracket or no tax bracket, because you will pay either the same tax rate or a higher one when it's removed. Fees for managed accounts are usually a little bit higher than unmanaged accounts. So, people that manage your money make monies, but you might not necessarily be saving in the grand scheme of things. If you don't have a spouse, do not pass away with an RRSP. And the more and more I talk with our elderly clients, the problem exists that they have this substantial RRSP because the generation has been taught to save and save and save and save and save. But there's a major disconnect with when it becomes time to spend. Now, we all want to leave assets for our children, But RRSPs are not something we leave to our children. They're only something we leave to a spouse because they can transfer to the spouse tax-free and be withdrawn at the same estimated rate that, would have applied to your life. But if you pass with nobody to transfer it through tax-free, then it becomes paid as 100% income. So if we put in RSP income at $30,000 or $40,000 income level a year to the point where we've got $100,000 or $200,000 of RRSPs and we pass away, that's $200,000 income, and we'll pay $100,000 in tax. And that's just, I find that unfair. So proper planning certainly goes a way as well.
How many tax brackets are there in Canada and in the U.S.?
Well, taxes are generally higher in the U.S., and that's one thing to touch on here. And secondly, there are about 5 federal Canadian tax brackets and 5 provincial tax brackets. I'll touch with BC right now because I'm in BC and I've got those numbers easy and handy. They combine together to make your total effective tax rate on your tax return. So there's one tax schedule for the federal rates and there's one tax schedule for the provincial rates. And same vice versa for the state. You'll have a federal return where all of your income will be related to, and then you'll have the possibility of a state tax return, with California being the most tax-aggressive state in the United States. And by that, I mean they do not provide a foreign tax credit. So if you have foreign income, you will be double taxed in the state of California on that income. New York being one of the second tax-aggressive states in the United States in terms of forcing to report and everything like that. But back to the rates, there's 5 federal rates in Canada. The rates are on income, or 15% on income up to $45,000, $45,916,000. So they say the first $45,000 you make, we'll charge 15% tax. On the income over $45,000 and up to $91,831, the rates are 20.5%. They go up to 26% for income up to $142,353 and 29% for up to $202,800, with 33% being the highest federal income on the highest federal percentage on income over $202,800. BC rates are much lower, but they stack up to add up the total rate. They start at 5.06% on income up to $38,898, with 7.7% up to $77,000, 10.5% up to $89,000, 12.29% up to $108,000, and 14.7% on income over $108,460. It's really complicated because both slides are different. The incomes don't match and the percentages aren't equal. So you can have a different rate and a different slide. It's not like each step is normalized for each individual income. The USA has 7 tax rates per filing category and 4 filing categories. You can file as married, filing jointly, married, filing separately, head of household, or single. I'll talk about single rates because they're generally highest, and the married filing joint rates as they're generally the lowest, although you have to have the total family income in there. The benefit of a joint rate is that it's slightly lower on all of the income, and if you have a spouse with a low income, then you get a lower rate without the worry of triggering more tax. We'll start with the lowest federal rate at 10% up to $9,500. 12% up to $38,000, 22% up to $82,000, and 24% up to $157,000, 32% up to $200,000, and 35% up to $500,000, with 37% being the top tax rate on anything over $500,000. Married filing joint rates are 10% up to $19,000, 12% up to $77,000, 22% up to $165,000, 24% up to $315,000, and 22% up to $400,000, 35% up to $600,000, with the highest amount being 37% on any amounts over $600,000. There are Yeah, the U.S. also provides a sliding rate scale where they say you've got your income and it's going to fit you right on a table, and all of those tables are findable by Googling IRS tax rate.
It's moving money into registered plans a way to reduce taxes in Canada and the U.S.
Yes, it is. Both countries allow for equal treatment of registered retirement investments. It's always a good idea to defer taxes on income that would have taxes be paid at a higher rate now, and plan to take it out at a lower rate when your yearly income is far less. So we remember, why do we contribute to RRSPs? We want to be in a high tax bracket now to defer income to a later time when our retirement income is less than our income is now, so our effectual tax rate is lower. Deferred tax savings, as well as normally good investments available within the registered plan.
What is a spousal RRSP and how does it work?
A spousal RRSP is a contribution by the income earner to an account owned by the spouse. The deduction remains on the income earner's tax return, but the income withdrawal would be taxed on the spouse's return. This does not usually benefit a couple with equal incomes now or retirement incomes later. Meaning if you're in a relationship where both parties have equal incomes, it doesn't make much sense to make a spousal contribution. You're both going to kind of need the deduction in the tax return. What are they? It's the same types of investments. It's just the contribution to a spouse's account that's taking up your personal contribution limits. So often a spouse doesn't have a contribution limit because they don't have any income earned yearly. So the contribution room doesn't increase. The spouse who is working does have a contribution limit. And what they want to do is strategically plan for their future by giving their spouse some of those retirement benefits so that they can be taken out at a much lower tax rate than the main income earner that might also have a pension later in life.
We'll have more with Peter Ingram right after the break on This Week in Money.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with cross-border tax expert Peter Ingram. Peter, do some people sell their losing stocks to offset the capital gains tax due on their winning stocks?
Well, yes. And digging deeper into question one, some advisors will say to hold this loss and sell to offset gains of future accounts at a later time. Dare I say Nortel? I mean, some clients held the valueless stock many years before selling for stocks that were going to result in a capital gain. The effect is lowering the active income by triggering the loss. Others sell when they can and track the losses by carrying them forward for future use. That is more first come, first served, though, and doesn't allow for a strategic plan if needed. So we had many clients for years that had the Nortel stock tank. They might have invested thousands, maybe less, maybe more. And when it came to their stock being worth pennies on the dollar, they would hold that certificate for a period of time until a year that they had a really good capital gain. And then they could sell the Nortel stock, trigger a major loss on that, and then offset any of the gains that they made in the good portfolio or the good investment.
In Canada, resource companies can sell flow-through shares. What are they and how can they reduce someone's income tax?
Well, a flow-through share is a way to take an income and invest it into a resource sector to reduce taxes by lowering your income in the amount of the investment. effectually flowing your income through to a resource sector. It is a way to invest directly into the Canadian ground and economy rather than pay a tax that will get spent by the current government.
Are charitable contributions tax deductible in both Canada and the U.S.?
Yes, they are, but they are only part of itemized deductions in the USA. Itemized deductions have a minimum amount based on your filing category that you have to trigger before a deduction is created. But then it creates a deduction dollar for dollar up to a certain amount that then triggers a minimum tax. So you can't have an itemized deduction that far exceeds the unallowable benefit. It will trigger a minimum tax that will constantly go up. The caps change year to year. Talk to your advisor and they can give you the accurate value for the year in question. Canada only allows for a 17% deduction of the total charitable donation. So it's not a dollar for dollar. It's a portion of what you're contributing.
In the U.S., is it 100% deduction?
It is, but again, it's limited by the itemized deduction cap and alternative minimum tax.
Is that one of the reasons why Americans are said to be more charitable than Canadians?
Well, I'd like to say both countries are equally as charitable, but with the United States allowing mortgage interest and property taxes to be a deduction on the itemized deduction, it easily creates an amount large enough to trigger all charitable donations to be a dollar for dollar deduction. The average American doesn't exceed the cap of itemized deductions, so it's usually a good benefit. When you've got a $60,000 property tax a year and your itemized deductions are capped with an expensive mortgage interest paid a year as well, there's no point in charitable contributions. So everybody's personal situation is different, and this, again, is part of a strategic financial plan. It's also easier to start a foundation or a charity in the United States than it is in Canada. So a lot of people try to get involved with organizing or starting charities, which helps with their I've lost the word, with their charitable
foundations.
Yes, foundations.
Is that the reason why all these big name people, former politicians and so on, and celebrities form these charitable foundations are a great tax break?
Well, yeah, anything with a charitable status or not-for-profit allows you to structure your intentions into a charitable cause. And if you can, once you're done making an active income in the world, if you can, better your what's the word?
Philanthropy, yes.
Right? Whatever you're trying to do in the good set, it allows you to take a much easier charitable notion and get it started to run income through without paying tax on it in the eyes of the charity.
Are there other ways besides charitable donations to shelter personal income from taxes?
Yeah, but no. There's everybody wants a tax shelter, but they usually involve lots of investment strategizing and creative paperwork. So rather than saying that tax shelters exist everywhere, it's more saying the average person is not going to be saving tax at the cost of running those. If you're in the billions of dollars a year, there's some dollars to be saved for sure through the accounting fees and nightmares associated with running certain charitable entities.
Are the tax-free savings account in Canada and the Roth IRA in the U.S. important vehicles for people to use when investing?
Yeah. Everyone that has no U.S. attachment should have a TFSA maxed out. It's one of those things where in the United States, they consider it a trust, so you don't want to have a U.S. residential attachment. What I mean by residential attachment, or citizenship attachment, as I should also say, is the U.S. being a U.S. citizen and traveling abroad, they'll always treat you as a resident. So if you're an American in Canada, you should not own a tax-free savings account. The government does not consider them tax-free in the eyes of the IRS. Plus, there's special forms that usually have a cost associated to reporting attached. Just like an account called something that isn't something that has a fee attached. Doesn't make sense. Put it somewhere else. But if you're Canadian in Canada with no U.S. attachment, everybody should have a TFSA maxed out. It's the easiest tax shelter legal in Canada with no real financial cost associated. I will stress that most financial advisors try to get into a weekly contribution scheme, and those all have special fees attached. So take a look at the total fees attached in your TFSA portfolio at the end of the year and see if you're not maybe paying too many by doing a more of an annual contribution or a different type of structuring. That's always key to look at. When you move to the United States and you're a Canadian, you get a job transfer. Oh no, what do? You got to shut down and close out that TFSA immediately. As soon as you enter the United States for residency, you're going to be open up to residency filing requirements. That TFSA is going to be taxable. It's going to have special reporting. So the easiest thing to do is to close it out and make sure the account is closed, not open with $0, but closed before you set foot in the United States. A Roth IRA is a very similar account in the United States. And they allow you to contribute a certain amount each year, and it continues to be tax-free in its growth. Canada will allow you to enter into Canada and maintain the tax-free essence of the Roth IRA, as long as you do not contribute to the Roth IRA once you've entered Canadian residency. As soon as you enter Canadian residency, it triggers it to be a taxable account. So, strategic planning, knowing what you have, having an active financial advisor can all help make sure you don't suffer some minor fees or taxable losses or costs associated with one of these accounts for failing to plan properly.
What's the difference between tax avoidance and tax evasion?
Well, tax avoidance is the legal way of using the book to your advantage. Both Canada and the U.S. have many investment opportunities to reduce taxes by spending and investing into the economy. Tax evasion is someone who breaks a rule to save tax. You know, it's not illegal to have a Swiss bank account. We all hear this, we shake our finger. It is illegal to not report our income earned as taxable in Canada when you are a Canadian resident. So lots of people, you know, we've been chasing the Cayman Islands, we've been chasing the tax-free haven, and these are countries where people with lots of money, maybe $1 million bank account, want to put it in an interest-bearing account, say in Switzerland. And say their interest rate is 18% on $1 million because their economy is booming over there. Well, that's $18,000 of income they got paid. Say we're still talking Canadian dollars. So that Canadian resident with that Swiss income has to put it on their Canadian tax return or face tax evasion issues for failing to report income. We live in a worldwide income country, meaning all income that we earn everywhere around the world should be reported on a Canadian tax return. The United States is equal. They say as well, all income earned has to be reported. Canada's polite. We allow you to become a non-resident, travel around the world, build your asset, and return to the country. The United States is less polite. They'll treat you as a resident every year you travel around the world, no matter where you are. You must file a U.S. resident tax return with treaties and exemption credits available. So we quite often find people working around the countries in a taxable situation in the United States because something they've done in one country is not of the same benefit in another country. Getting back to tax avoidance, you know, both books that the governments give us to play with are complicated. Like I say, that it's too big for everybody to read. So it is best to have somebody that can cherry pick the best, most important things that apply to your ever-evolving life. And the same goes to say with the United States. Until we've got a government computer that equalizes everything and does it for us, very similar to the UK system, you know, but most of us don't want that either because then we just accept the way it is. Right now we kind of like being able to fight for a better situation.
People get confused about whether it's illegal not to pay taxes or illegal not to file a tax return every year. Why the confusion between the two, and what's the difference?
Well, I constantly run into people that have not filed their tax return because they're afraid of owing tax. And that just makes the situation worse. If the best planning you could have, if you're going to owe taxes, file your tax return on time. The government will assess an amount due. They will throw you in collections if you owe amounts over $3,000. But the interest rate on Canadian amount due is about 6%, or it's less than 6%. So most of our banks, line of credit, current, how do we borrow, those types of accounts have a higher interest rate than what the government of Canada charges. Now, you can't go into a bank and borrow money when you owe the government money. You can't buy a house. Your credit's kind of up Poops Creek, so to say. But one of the things is it's the cheapest place to owe. Now, if you don't file on time, that changes everything. The interest rate can be up to 27.5%. You can have a 27.5% penalty attached. There can be a whole calamity of things that get triggered for not filing. So even if you're afraid of owing, the best thing you can do is file on time and just deal with the collections to the best of your ability. They're always fair with the payment plan. They're always fair as long as you follow it and you don't deviate from whatever you can work out with them.
Yes, I recall a person who was on a very low wage. They owed tax, and they said, well, I can give you $25 a month. Here's some post-dated checks. Is that a good enough system to pay off your due taxes?
Well, a low-income situation, we hope that person didn't owe too much. But the government is going to have a lot of trouble milking blood from a stone when you just don't have anything to give them. So $25 a month is something that I advise clients to always partake in, no matter if they have enough money or not to pay down their debts. If you treat the government like a credit card company, you cannot miss a payment on a credit card. You should not miss a payment with the government. Pay them the most you can, and if the most you can is $25 a month, at least there's a credit to your account that is not triggering a non-payment per month.
Peter, how can people contact you and find out more about Senta?
Okay, well, my website's www.centa.com. That's Charlie Echo Norman Tango Alpha.com. My email address is peter@Senta.com. Papa Echo Tango Echo Romeo @Charlie Echo Norman Tango Alpha.com. My phone number is 1-866-980-0499 for a toll-free. My local number to the GVRD is 1-604-980-0321. Or if you're out in the valley, I got 1-604-858-4562.
Peter, thanks a lot for being on This Week in Money.
Thank you for having me.
My guest has been cross-border tax expert Peter Ingram. He's with Senta in Vancouver. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Wolf Richter, and Peter Ingram. And thank you for listening. Now stand by for company showcase updates from American Manganese CEO Larry Reaugh and Aven Resources President Jim Pettit. If you have any questions for the show, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
You just put out a news release. What's in it?
Well, we're talking about finally getting the pilot plant up and started. We expect it will be functioning by mid-December, in around that range. And it's timely for us because on December the 6th, we have a group coming out from Europe that want to look at our technology, and they see some synergies, so do we, between their technologies and ours. And they'll be out to look at the work that's going on, current work that's going on at Kemetco, and we hope that we'll be able to take them out to where the pilot plant is being constructed and show them our progress on that. So it's a timely release. I know that people have been waiting for it, but science is science, and it's not math. So it's basically you do the math, and then you got to prove that it works that way, and it takes time. So we've utilized the time. It looks like we're going to have some additional patents come out of this, some new IPs. So we're pretty happy with the progress that's going on. And when I'm talking about progress, I expect that at any time we could, hear back from the patent office that our patent has been granted, because, as I've been saying before, there doesn't seem to be any showstoppers, or there were no showstoppers whatsoever in what we were doing. So that's another big positive. I think all these things could happen before the end of the year, which would be great. Of course, as you see, Jim, we would also announce the private placement. I think we've got commitments for up to a third of that so far, and we hope to be closing some of it next week. So that will certainly make everybody feel better. We'll be able to continue with the ongoing work. This is a disruptive technology that is really starting to be recognized by the press out there. You're starting to see a lot more articles on recycling, which you didn't see as a month ago. And now recycling is starting to really warm up out there. So, as far as we're concerned, we've got the lead in getting 100% of the cathode material back, total circular economy. And, that's been our goal all along, and we're working towards that. That said and done, I know that people are anxious about this market. And, you can see that the mining stocks and all those ones are getting hit pretty hard. And, but we feel that this technology that we have has got a real value to it. And that's being recognized in the market. So there's other things that are happening, Jim, that make warms the cockles of my heart, gives me a good Christmas, I hope, and our shareholders certainly. And if you notice that the exchange is going down, especially the Toronto Stock Exchange Venture, it's on lighter volume. So it could have a rebound at any time. So that's about all the news that I have right now, Jim, is the market is what we have no control over. As a matter of fact, we have very little control over anything outside of our lab, the Kemetco lab, or our office here. We're always waiting for something. But that's the way it happens, and we live with that. It's all I know is I'm very confident about what we have.
Larry, for new listeners, what's American Manganese all about?
American Manganese is a critical metals company that developed a process back in 2009, 10, and 11 that allowed them to compete with China on producing electrolytic metals and dioxides at the same cost as China, utilizing ores in the United States that were 10 to 20 times less grade. So, we're talking 2% versus 30%, 3% versus 50%. So we were able to do that, and that technology is we have 4 IPs on that. Not 4 IPs, 4 locations where it's the patent has been granted, and that is U.S., China, South Africa, and Canada. And now we're moving ahead with expanding on that technology to disrupt the EV battery business by being able to recycle 100% of the cathode materials. And so we've been very successful in doing that. All of our bench scale work and everything else has done it. We're coming close to the production from our pilot plant. That will give us 1,000 tons, not 1,000 tons, a ton of material that we can send off to a battery manufacturer that wanted to test our process in their batteries. So it's great times.
Larry, where are you traded?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM.
Larry, how can people get more information about you?
They can get all the information out there, like our business plans and everything else on our website, all our news releases, American Manganese Inc.com. They can phone the office here at 778-574-4444. They can email me at lray@amymn.com.
Larry, thanks for the update.
You're welcome.
We've been speaking with Larry Ray, CEO and President of American Manganese. Our conversation took place November 23rd. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of Aven Resources. Welcome back to the show, Jim.
Thank you very much, Jim.
Jim, what's new with Aven Resources?
What's news? The last batch of holes we just put out. Actually, it surprised me because it was 15 holes. I was expecting it to be about 7 to 9, but they all kind of come piling in while I was away on a marketing trip. They were less than stellar, and I couldn't have thought of a worse time to put out bad news, right smack in the heart of tax loss selling, but it is what it is. You got to take the good with the bad and move on. We did learn a lot from what we've got now, all that cores-oriented core drilling and helping us get a handle on structure and orientation of what we're looking at, because that's really important.
So where do you go from here? Is there more drilling, more testing?
Yeah, we got 9 more holes to report on, and I'm just off the top of my head, that could be by the end of the month, based on the fact that everything else sort of came in one big avalanche. After waiting and waiting and waiting, and all of a sudden, boom, there it is. And so I suspect we'll have that maybe towards the end of the month, and that'll be it for the season, other than data compilation. And I've got some news coming out of the Justin property, I suspect beginning of December-ish, which could be exciting. It's not the primary focus for us this year, but it certainly is. It'll be good news. I'm hopeful. And we'll be getting ready gradually for the Chico project as well later on in, like February, March-ish. Once it's good and frozen, I think we can get in there. And so, we're not without news. The market's come down. It's trading in a range above the last financing. It's not as bad as what happened last year at the end of the season up at Forest Kerr. But I think it'll have the opportunity to bounce with the amount of news we've got coming out and the other projects kicking in. So, I'm hopeful.
Jim, where is Aven traded?
Aven's trading on the Toronto Stock Exchange, the TSX-V, as well as the OTC QB markets in the States under ABN.V.
And if people needed to get more information about the company, where can they go?
Well, they can certainly go to the website, www.avenresources.com, or call the office, 604-687-3376.
Jim, thanks for the update.
You bet. Thanks.
We've been speaking with Jim Pettit, CEO and President of Aven Resources. I'm Jim Goddard. Our conversation took place on November 22nd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.